continuity. All right, good afternoon, everyone. A couple announcements before we get started. So just wanted to remind everyone again about tutoring that's available, free tutoring. So if there's anything you want some extra help with, some more back and forth with someone, this can be a great opportunity for you. I have the link here. It's all over, I think, Zoom. So this is the schedule when tutors are available. Again, totally free. Definitely recommend taking advantage of this. Just can be another source for you to study. So recommend checking that out. There's also the National Science Foundation has basically a research program available. If that's something that you're interested in, there's some more information posted here. Register to vote if you haven't already, right? Part of our civic duty, so you should go do that. Bunch of events going on this week. Well, it's the morning networking event. It's the afternoon already. But tonight there's an FMA networking event going on. I posted about this earlier, but especially for economics and finance majors, highly recommend that you attend this. There are going to be some executives from some local companies there, and they hire often from MTSU. So if you're in the field, definitely recommend attending this event tonight. It can be extremely valuable. Thursday, there's the Risk Management and Insurance Career Fair. So this is going on partially during class, so if you can get there before class, even better. But class is recorded, posted online, so if this is the only time that you can attend this, and you're interested in risk management or insurance as a career, it can be an extremely valuable profession. Right, I mentioned during, I think at the start of this class, I'm studying to get CFP certification. And risk management and insurance is a really important aspect of managing your own finances and helping other people manage theirs. So if that's something you're interested in, this is going to be available. Personal branding also available Thursday, and our leadership summit at the end of the month. Midterm grades were posted. That's what reminded me about the tutoring. Overall, y'all are doing, on average, fine. So just keep up the work. Remember to practice this material. It's not the most intuitive sort of information, and it just requires, to some extent, just literally just practicing and practicing. I know I also mentioned, right, I failed my first exam in finance in my undergraduate, so it does take work. But like I mentioned, I think here, midterm grade is only for units 1 and 2, so that's a small fraction of your overall grade. Plenty of room to bring your grade up. Conversely, plenty of room for your grade to drop. So keep up the work and all your studying. And last announcement, the career fair. When is this? Next Tuesday. So that's going to be more in the morning to early afternoon in the courtyard out here. So this can be another good opportunity for you. I believe, these are paid internships. So if you're unsure what you're interested in, this can be a great opportunity to kind of explore some options. All right. Any questions before we get started? Okay. So last class we started talking about bonds, and today we're going to be talking about them some more. Specific things, we're going to be talking a little bit more about inflation, interest rates, right? Federal Reserve. Jerome Powell was just in Nashville yesterday, and I'm so bummed I didn't know about it ahead of time. I would have loved to seen one of his speeches in person. Right, but inflation and interest rates are really important to the economy more broadly, and they're also important to us specifically in this field, financial economics. So we're going to talk a little bit about that. Also a little bit more about determinants of bond yields, and I'm pretty sure we already calculated bond values, but we'll go over that again real quick. All right, so inflation plays an incredibly important role in monetary policy, and because the Federal Reserve's mandates are to maximize employment and have a low, stable inflation rate. All right, so basically what the Federal Reserve does is if inflation starts increasing too much, which it started to do around 4 years ago now, what the Federal Reserve can help do to offset that is increase interest rates, making it more costly to borrow money, which is basically an aggregate brake on economic output. All right, so monetary policy sets the basic interest rate from which all other interest rates are going to be determined. Not just in the U.S., but really internationally, many interest rates are pegged to the interest rate that the U.S. Federal Reserve sets. So our monetary policy in this country is incredibly important for us and for financial institutions across the world. So understanding that association between inflation and interest rates is really important. Right? So when the economy starts overheating is basically how people usually frame it. The Federal Reserve tends to increase interest rates to help combat that increase in inflation and try to bring the inflation rate down a little bit. Conversely, if inflation is too low or employment is too low, then something they can do to help stimulate the economy is to lower interest rates. Right? Important to keep in mind that the Federal Reserve's main policy tool is managing interest rates, the interest rates that they set on basically the notes and bonds and bills that the U.S. government is going to be issuing. Right? But that's just monetary policy. Fiscal policy is set by the legislative agenda, the presidential and legislative branch of the U.S. Sets fiscal policy. And keep in mind that inflation is going to be eroding the purchasing power of money across time. Yes?
So do you believe, like, if inflation keeps going up, do you think that's going to affect the interest rate, or it might not? Or, like, in other words, if inflation keeps going up, does interest rate will go up as well?
So not necessarily automatically, but usually by the interest rate that the Federal Reserve sets. So usually the Fed reacts to changes in inflation, like I just outlined, right? So inflation increased 4 or 5 years ago. So the Federal Reserve increased interest rates in response to try to combat that increase in inflation. Inflation has been declining significantly. So the Federal Reserve is reversing course and lowering interest rates a little bit because there's starting to be a little bit of economic headwind, they like to say, right? There's been a slowdown in employment growth and stuff like that. Inflation has gone down, so the Fed is starting to slowly lower interest rates. Right, so it's not that they necessarily follow one another without any intervention. Often the intervention is the Federal Reserve acting with monetary policy to accommodate inflation.
So pretty much the Federal Reserve is the main factor between those two, between the inflation.
What factor?
So do you believe that the Federal Reserve is like the main decider, or
Yes.
like decider whether or not interest rate or inflation is going to go up?
Not so. Inflation can increase without any action by the Federal Reserve.
Oh, okay.
The Federal Reserve can affect inflation through their monetary policy, but usually they're responding to some sort of exogenous shock in the economic system more broadly. Right. So our inflation started around COVID with there's a lot of things, but basically lean supply chain management resulted in a shock to supplies that we wanted to purchase. That resulted in an increase in prices more generally, and then there was also a lot of fiscal stimulus around that time. So in aggregate, there's a lot of inflationary pressure. The Federal Reserve responded by monetary policy, increasing interest rates, which helps combat inflation, which it did. In absence of the Federal Reserve, there is generally a positive relationship between interest rates and inflation. But because the Federal Reserve actively manages the monetary system through managing the interest rate, then very often we see the Federal Reserve act basically as a counterbalance to what's going on with inflation. Yeah. Any other questions?
Mm-hmm. How does that work? How does raising interest make inflation slow down? Or is that too big of a question?
No, I'm just trying to think of how to explain it as simply as possible without going too far out of here. So basically the mechanism is the cost of money. Right? So if you want to borrow in order to make a purchase, like buy a car, everything else equal, you're going to be less likely to buy a car if interest rates are higher, right? Because that's going to increase your monthly. Another thing would be housing, right? If you're thinking about purchasing a home, your mortgage is going to be much more expensive if interest rates are higher, Right? We did some examples looking at that. As we saw higher interest rates, our monthly mortgage payment is significantly higher just from a change in the interest rates. So increasing interest rates basically helps drive down economic interest in purchasing, which is about 70% of our economic output. Right? About 70% of our GDP is consumer spending. Right? So anything that marginally reduces the consumer's ability or intent to spend right now is going to lower demand for money because basically money is more expensive. Yeah. Any other questions? All right. All right, so inflation erodes purchasing power of money, meaning a single dollar purchases less. Right? When the grocery store prices increase, right, we see that it's more costly when we're checking out at the grocery store. The same dollar amount that we were spending, say, 5 years ago, buys fewer groceries than today. Right? So inflation is one of the key things that the Federal Reserve or the monetary policy setters is going to be interested in paying attention to when they're setting their interest rates. Right, and like that I showed you last time, Treasury Direct is basically how the federal government is going to be issuing bonds to individual investors like us. Right, and I provided a link in the PowerPoint from last class. So if you're interested in looking at purchasing, investing in government securities, that's available for you. But it also shows you, right, what's the interest rate that you're going to be getting on those sorts of investments. So real rates are the difference between the nominal rate that we're looking at and inflation, right? In other words, real rates are the nominal return minus the inflation rate. When we say adjusted in economics, really we just mean we subtracted something. So when we're talking about real rates of return, we're subtracting out the inflation rate from the nominal rate of return that we're looking at, right? So when you're quoted an interest rate, usually you're going to be given the nominal rate, and you can look at the real rate of interest by subtracting out the inflation rate. The important distinction here is real rates reflect your actual purchasing power, right? When we're adjusting for inflation, we're adjusting for how much can we actually purchase with a given dollar amount. That's the whole central concept with time value that we started off this class talking about, right? The timing of cash matters for the value of that cash. The further into the future we receive a cash flow, the less it's going to be worth today. And conversely, the longer that we can save up our savings and investments for, the more it's going to exponentially compound. Right, so the real rate of interest is how we can look at the actual purchasing power of those cash flows once we've adjusted for inflation.
So do you say that for real rates we subtract the, what was it, the inflation?
Yeah.
Inflation? Yeah. The inflation from what?
Just general inflation, yeah. Right, so inflation is defined as the increase in cost of goods and services.
And with nominal rate, we don't subtract?
Correct. That's just the basic rate, typically what you're going to be quoted. I had that in there as well. Right. Rates are almost always quoted in nominal terms. Usually it's in economic discussion where you'll hear things about real rates of interest or real rates of return. Right. I think I already mentioned this when we discussed time value, but should we use nominal rates or real rates when we're using our discount rate? Right. So it's kind of a trick question for me. Technically, it doesn't matter. We can use either one. So long as we go about this correctly, we're going to get the same answer. So the important thing is that we're consistent in whatever we're doing. Generally speaking, it's better to use nominal rates because there's fewer steps involved and you get the same answer. Right? And everything else equal, we should try to do what's easier. We're already doing a lot of work when we're dealing with time value, so let's just use the easier option that's available to us. All right, so a little bit of a trick question. You can use either. As long as you're consistent, generally I recommend using the nominal rate because it's just going to be a little bit easier.
Well, what would it be the same if you're not adjusting for inflation? Because it would make sense.
That's what you have to do though. When you use the real rate of return, you have to use the real dollar rates in the cash flows. So you would be adjusting both the cash flows and the discount rate applied to those cash flows.
So with the nominal, you do like both at the same time.
So when we're using the nominal discount rate, we're basically, inflation is assumed in the cash flows. Inflation is also assumed in the discount rate that we're using. So it's easiest just to use nominal rates rather than discounting both the cash flows and getting the real rate of return. So we also have a more explicit association that we can see between inflation and interest rates through what's called the Fisher effect. So basically what we're looking here is in the simple formula here, we see the nominal NRN, the nominal rate of interest, is equal to the real rate of interest plus the inflation rate. Really, this is just rearranging this association I gave you, right? So if the real rate of return is equal to the nominal rate of return minus inflation, we're just rearranging this to get the nominal rate of return is equal to the real rate plus inflation. Right? So the Fisher effect, economists like 50 to 100 years ago had a really easy time with things. They just had to do a little bit of algebra to get their name tied to a theory that's taught nowadays. Things have gotten a lot more complicated in economic research. Right, but basically what the Fisher effect is saying is, again, nominal rate is just positively related to the real rate of interest plus inflation that's occurring over that time. The problem with this is it's not showing the compounded effect, right? If we keep in mind when things grow across time, there's exponential growth across time, right? It's not just increasing at an additive rate. So a better way to look at this association is 1 plus the nominal rate of return is equal to 1 plus the real rate of return times 1 plus the inflation rate. So very often people deal with the Fisher effect using the simple formula, but technically the compounded effect is the more appropriate way to make the adjustment. And the way that if you were to use the real rates of return, you'd have to use the compounded Fisher effect in order to deflate both the cash flows and the discount rate that we'd be applying to those cash flows. So again, much easier to just use the nominal cash flows and the nominal discount rates when you're doing any sort of time value adjustment. The key thing that we're getting out of this is that nominal interest rates are positively related to inflation. So when there's an increase in inflation, we tend to see an increase in interest rates. So economies that operate without a central bank, they do tend to see a positive association between them. But we see this positive association more closely in economies that have central banks that are engaging in monetary policy. Right? It's standard monetary policy at this point that when inflation increases, we should increase interest rates in order to combat that. Right? It makes it more expensive to be purchasing things, makes it more expensive to borrow, to purchase things. So increasing interest rates can help combat that inflation by lowering demand. All right, so holding the nominal rate of interest constant, the higher inflation we have reduces the real rate of return. Right, so we can look at that using this initial format of the Fisher effect that I was talking about. So if we increase interest rates, right, because we're subtracting the interest rate from the nominal rate, if we increase inflation rates, that's going to reduce the real interest rate that we're looking at. Important to keep in mind, this is a simplified effect. Generally, there is this positive association between nominal rates and interest and inverse association between real rates and interest, but it's not this one-to-one association that we see in this equation. This is just basic economic theory And as we'll see in a little bit, there's actually a lot of factors that go into interest rates and inflation. Particularly, we're going to look at some of the things that go into building up interest rates. So just a quick example, I don't think we even need to go over to Excel for this one, right? But inflation is expected to be 1.5%, and the real interest rate for short-term bonds is 1%. What's the nominal rate of return? All we have to do is, in the simple framework, add those together. All right, so inflation is 1.5%, real interest is 1%, so add those together, you get 2.5%. If we're looking at the compounded effect, it would be 1 plus the real rate times 1 plus the inflation rate. So 1.015 times 1.01 gets us a little bit more, right? Remember, when we're controlling for compounding, we're going to find that growth rates are going to be a little bit more. That's the compounding effect. Any questions on calculating nominal or real rates? Yes.
When calculating the compound, you have to find you have to find the nominal rate first. Is that a step we would have to take normally, or would they give us the nominal rate if we're trying to find
So it depends, right? There's 3 inputs here. You need at least 2 to solve for whatever the missing variable is. So if you're asked to solve, say, the real rate of interest under the simple framework, you just add them together. Under the, if you're looking for the compounded nominal rate, you'd have to add 1 to each of the variables and then multiply them together, right? So just important to keep the order of operations consistent, especially when you're in Excel. It's not going to assume brackets around your variables. On the flip side, if you're solving for the real rate of interest, that's going to be 1 plus your nominal rate. So in this case, 1.02515 divided by our 1 plus inflation, or 1.01. Any other questions? All right, so this is one of the basic associations we can look at. What are some of the other things that are going to affect the discount rate and the coupon rate that's going on a bond? All right, so these are 2 of the factors that really determine a bond's price and any change in that bond's price over time, particularly the yield to maturity. And so the basic ideas that we're going to be looking at here are, as we increase the risk of an asset, we should see an increase in the expected return. And we're going to see a lot more of this, I think, starting next week. But basically, when we look across asset classes, when we see the aggregate risk of those different asset classes, we see a pretty strong positive association in return across that increase in risk. And so that's the basic idea of no risk, no reward sort of thing, right? That applies very heavily when we're looking at rates of return on different assets. As we increase the risk, we increase the expected return on an asset. Right? So when we're looking at any factor that might increase the risk of a bond, we should expect that that risky factor is going to increase the expected return for the bond as well. Usually we are going to refer to this as the risk-return association or a risk premium. Right? And so when we talk about a premium, that just reflects that we're being compensated for holding on to this additional risk that we're being exposed to. All right, so if you think about it in another way, if I asked to borrow $100 from you for 5 minutes or $100 from you for a year, which one do you think is a riskier proposition? Which one do you think you're less likely to get your money back in? Yeah, right? The more time between the promise of payment and when you actually forego that money, the more likely it is that you're just going to lose that money. Right? On a personal basis, right? People will forget. Right? You lend friend or family some money, like, oh, what are you talking about? I don't remember any of that. When you're dealing with asset classes, the more risky thing is the entity that you're lending to actually still going to exist in the future? And in the short run, it's likely, right? Apple is one of the largest, most profitable companies in the world. Lending money to that company is almost as guaranteed as you can get in being repaid. Going out a year or 2 from now, they're probably going to be able to pay you back. They have enough cash reserves to run for a while. Going out 5 to 10 years, it's a little, you don't really know for sure. Going out 10 to 20 years, which is the framework for a lot of bonds that are being issued, 10, 20, 30 years into the future? We don't know, right? 10 years is enough time for a company to completely crumble and go out of existence. So you could be looking at one of the most profitable companies in the world right now, but in 30 years, you don't know whether it's going to be profitable as well, right? So that's going to be something related to just the pure time of the riskiness of an asset. All right, so whenever we're looking at any of these risk premiums, really what we're looking at is there's some sort of risk factor that's going to increase the return that investors should expect to earn for holding on to that asset. All right, so what are some of the particulars that are going to be related to bonds? The first is the term structure of interest rates. All right, so this is related to a bond's term to maturity, or how long a bond exists. Basically for the reason that I just mentioned, right? Everything else equal, the further into the future you're receiving a cash flow, the less likely it becomes that you're going to receive that cash flow back. Just the nature of uncertainty in the future. All right, so when we're talking about the yield curve, very often that's going to refer to U.S. Treasury bonds and notes. And we're going to see a graph on what those look like in a little bit. And this is basically one of the base rates that all other interest rates are going to be based off of. So when you see interest rates for something like a mortgage that you're considering taking out, very often it's going to be tied to the underlying 30-year note that the U.S. government is going to be paying interest on. In general, and on average, longer maturities are going to have higher interest rates than shorter maturities. Usually that's going to be because it's going to be riskier to hold debt over longer time periods, right? You're exposed to more risks. There's a higher probability of default. There's just more things going on over longer time periods that can reduce your probability of receiving payment. Keep in mind, that's the normal association. It's not what we always see, and we have something a little interesting going on in the bond market right now. So it's possible to see that yield curves might invert, right? Basically, shorter term interest rates have higher cost of interest than further term interest rates. All right, so there's some interesting things with this, and the reason why there's so much attention that goes into the yield curve is research has found that typically prior to economic recessions, we find an inversion in the yield curve. All right, and so very often what we see is prior to a recession, we see an inverted yield curve. So for example, right, late 2019, the yield curve started inverting. There wasn't anything on the horizon to suggest that there's going to be an imminent recession. Economic data overall was good. What happened in early 2020 that caused a recession? Yeah, and there was a recession. All right, so when we look at the yield curve, this can often predate economic recessions. It should be pointed out, though, that it overpredicts recessionary periods, right? So while inverted yield curves do precede recessions, they often still occur without a recession following. All right, so what does the yield curve look like today? It's still inverted. All right, so there's some discussion with some economic agencies whether there was a very mild recession earlier this year, but so far data doesn't bear that through. So there's still some contention that we might be experiencing a recession in the somewhat near future, right? Similar to what we saw 4 years ago. Right? Economic data looks fine, but it's still possible that there's going to be a recession coming up in the near future. Right? Because right now we still see there's an inverted yield curve, and this is as of, I think it was 9 o'clock this morning that I pulled this up. Unlikely to have switched since then, right? I don't think the Treasury is doing another bond issue for a couple more days. So we'll see. Maybe we'll see some changes in interest rates after the next round of bill activity. But right, we've had an inverted yield curve for a little while now. So we'll see if there's a recession. Right? Thankfully, I'm an economist, so either way, it can be interesting for me. For other people, though, right, recessions are pretty detrimental for most people most of the time. Academia, though, interestingly, is inversely related to economic output, right? So there's higher enrollment in higher education when there's worse economic activity more broadly, especially in grad schools. All right, so the term structure of interest rates is one of the baseline associations for what we see in the cost of interest. Some other things that are going to be associated is an inflation premium. All right, so this is going to be embedded usually in the term structure of interest rates, so that's why we typically see longer maturity bonds having a higher cost of interest. We also have the interest rate risk premium. right? So this is how sensitive a bond's price is to changes in interest rates. And it's going to be compensation for investors for bearing that interest rate risk, right? So the more a yield to maturity or discount rate changes, the more price sensitive bonds are going to change as a result of changes in that discount rate. Right, and what we were just looking at is the Treasury yield curve, right? So that's just a reflection of the yields on Treasury notes at different maturities. Always important to keep in mind, right? The Treasury sets the interest rates for the aggregate economy, and very often all interest rates follow or at least predict what the Federal Reserve is going to do, right? A really interesting thing with that in asset markets is a lot of market participants try to predict where things are going to be going. And mortgage rates started dropping significantly over the last year before the Federal Reserve ever stated that they were going to be dropping interest rates, right? So very often, even just the sense that the Fed is going to be changing monetary policy can result in the effect that they're expecting, which is what we saw in mortgage rates. We also have a default risk premium, right? So some investments are much more likely to default than others. So at a country level, the U.S. is one of the safest investment sources in the world. Unfortunately, we've had credit degradation over the last 5 years. I think it may have reverted actually since then, back to the AAA rating. I should double check that. But anyway, there are other countries that's not the case, right? So Greece and Italy are a good example. I believe it was a little bit over 6 years ago now, Greece was starting to go through some credit issues, and it was looking like they were going to default. And there are some other countries that are struggling to pay off some of their outstanding debt as well. So one thing that we can look at to see whether or not a country or company itself is going to default is looking at the bond ratings for that entity. All right, so the higher rated the company or country is, the less likely it is to default on any debt outstanding. We also have a taxability premium, right? So municipal bonds that are issued by municipalities, lower government institutions, tend to have interest that is tax-free, right? So that's going to be something that's in high demand for higher taxed individuals. Right? Not having to pay tax on return can be highly beneficial. And there's also a liquidity premium, like we were talking about last class. Bonds aren't actively traded as much, right? Very often people will purchase a bond with the intent of holding to maturity, so there's not as much active trading. While equity, in theory, is similar, right? You can hold on to stocks indefinitely. There tends to be a lot more active trading in equity markets over time. All right, so the more illiquid a bond is, the higher risk premium that investors are going to have to hold the higher a risk premium a bond's going to have to pay in order for investors to have incentive to hold on to those bonds. So I mentioned a lot of individual risk premiums here, but basically you can think of these interest rates as just basically tacking on to the cost of interest. Right, so every single premium that you're looking at is just adding another layer of risk to the holder of those securities. So over time, you can just basically tack on those risks to whatever individual bond that you're looking at. All right, so I mentioned interest rate risk, and there's going to be a way that we can actually measure that sensitivity to a bond's price changes in interest rates. And that's going to be through what we call duration. Right, so duration is going to be our measure of interest rate sensitivity. All right, so by definition, it's the percent change of price to a change in yield. Right, so for mathier people, it's the first derivative of a bond's price relative to changes in interest rates. Another way that we can think of it is a time-weighted average of a bond's cash flows. And what I mean by that is we just literally multiply the year that a cash flow occurs by the cash flow itself. So if a cash flow is occurring 2 years from now, we would multiply that cash flow by 2. All right, so this is the formula for measuring duration. You don't have to memorize it. We'll have a function that we can use to calculate this. But really all we're looking at, like I mentioned, the time weighted. So this is just a present value problem, right? So this is a DCF in the denominator, right? Discounted cash flow is we take each cash flow, divide it by our discount factor, add it all up. All right, so this is something that we've seen explicitly. Now what we have in the numerator is it's very similar to the DCF we've already seen. The only change now is we're multiplying the year that cash flow occurs times that discounted present value. All right, so the numerator is the time-weighted cash flows, and the denominator is the present value of the cash flows. So in other words, multiply the present value of each cash flow, so that's going to be coupon and par being paid out if it's paid out at that time, by the time period when that cash flow occurs. And divide all that by the present value. All right, and the important takeaway from this is 2 things. 1, the maturity. The longer the maturity, the longer until we receive our cash flow back through par, the riskier those cash flows are going to be. And the lower the coupon, the riskier those cash flows are going to be. Similar idea. The lower the coupon just means that we're not receiving as much of our money right now. All right, so everything else equal, the further into the future we receive our cash flow, the riskier that cash flow is going to be. That's basically what this information is telling us. And again, I know this can be a somewhat intimidating formula, but we've got a function in Excel that's going to take care of this for us. And really what this comes down to is a DCF problem for us, which we've already done. Any questions on interest rate risks or duration? Yes.
Well, you said the duration measures what? What was that again?
Sensitivity of a bond's price to changes in its discount rate. That was on the, yeah. Sensitivity of a bond's price to changes in interest rate is more broad. I should have said the discount rate to the bond.
And coupon, what exactly is coupon?
Right? Coupons are the payments for a bond, right? So it's basically interest that you're getting paid out to you on an annual basis, right? So there's 2 general types of bonds. There's pure discount bonds, where you purchase a bond at its discounted price, and your return on investment is being paid the full price, right? So for example, actually let's look at the Excel sheet. We did an example on that, I think, last week. All right, so if we receive a $1,000 bond in 8 years and it's got a 5.5% discount rate, in other words, a pure discount bond would be we pay $651 today in order to receive $1,000 in 8 years. So that would be a pure discount bond. And on the other hand, we have coupon bonds, which pay out a rate of interest every year. So in this case, a 6.5% coupon. So if it's a 6.5% coupon that's paid out annually, we'd be getting $65 in interest every year. Right? So the difference between a pure discount and a coupon bond is pure discount, we just pay the present value and we receive the lump sum future value whenever maturity occurs. And with the coupon bond, we're receiving these payments every single year. Any other questions? Sure, I think we might be jumping back into Excel here. No. So I think I had mentioned this last class, but just as a refresher on it, right? When we're dealing with bonds, really we're just dealing with time value that we've already covered. Unfortunately, the bond market is extremely old. It's one of the oldest asset markets in the world. And some of the terms that are used in this market are pretty antiquated. Everything that we're talking about with a bond correlates directly to something that we've already done with time value, right? We're dealing with payments. We're dealing with present values and future values. We're dealing with discount rates and time periods. Right? All of that just has specific nomenclature within the bond market. All right, and I do have a table in the previous, let me pull that up real quick. Yeah, there we go. All right, so this is the PowerPoint from last class, the Bonds 1 PowerPoint. And in here, I have this link between the bond terms and what we've already seen in time value. All right, so the price is the present value. The face value or par value is the future value. These happen to match up pretty nicely. The time to maturity is just the number of years until those cash flows occur, or until the maturity of the bond. The yield to maturity is the discount rate on the bond. And lastly, the coupon is going to be the payment of a bond. Again, everything we're dealing with in the bond market is something we've already covered with time value. It's just unfortunately specific to bond markets. I'm very much in favor of changing all that and we're just dealing with time value. We don't need to deal with these asset individual cash flows. My personal opinion is people in the field people in many fields like to use unnecessarily complicated verbiage to describe things. That gives them a little bit more credence and very often a little more bargaining power and salaries. So incentives, right? But really, again, everything we're dealing with is just time value information that we've already dealt with. Right? So bonds, price, present value, face value, future value, maturity, number of periods, yield to maturity, discount rate, coupon, payment, or recurring cash flow. Right, so when we're dealing with a bond, again, it's either an annuity or a pure discount bond. All right, so really what we're dealing with is a DCF problem. Right? And a reminder, a DCF problem, we have our cash flow in a given period divided by our discount factor for that period and sum up all those present values to get the overall value of the bond or the asset that we're looking at. So if we're looking at a bond specifically, the payments that we're dealing with are coupons every year, and our future value or single occurring cash flow is going to be the par value paid out at maturity. So if we're dealing with a pure discount bond, you could just take your par value. It's going to be a straight present value problem, right? Just a pure present value problem. That's the first thing that we started calculating when we were dealing with time value. So the bond value is going to be equal to the par value being paid out at maturity divided by 1 plus the discount rate or yield to maturity raised to the number of years or the maturity of the bond. All right, so we already did these problems. Let's see. Yeah, so we already went over those in Excel last class. So the last couple of problems we're going to look at here are dealing with duration. All right, so the little reminder I have here is we increase the coupon rates, we decrease our interest rate risk, and we increase our maturity, we increase our interest rate risk. So we're going to do a couple duration problems to close out the bond section. All right, so like I mentioned, right, duration has a pretty rough looking formula, but this is one of those times where we also have a Excel function that really simplifies this. All right, so long as you have the information that you need. All right, so again, Excel, when you pull up the function, it'll give you the definition. So it returns the annual duration of a security with periodic interest rate payments. Perfect. All right, so the information that it needs settlement or date that you're purchasing the bond. It needs the maturity time period or the day the bond closes. Pays out the par value. It's also going to need your coupon rate, your yield, and the frequency. How many times per year does the bond pay out? In this case, it's going to be semi-annual. Whoops. There we go. All right, and we have our duration value. All right, so the more important bit of information we get here is the comparative value. So I'm just going to copy and paste this down to the example below. The information is all set up the same, right? See, I've got the settlement, maturity, coupon, yield, number of compounding periods per year. All the input information is established the same. So we can copy and paste this function on down. So I'll just Control C, Control V, and it's getting us our measure of duration. So basically what's going on here is the second bond that we're looking at is less sensitive to changes in interest rates. Now we got two more problems, similarly structured. So again, we've got our settlement, our maturity, our coupon, our yield, and our compounding rate. So both these bonds look pretty similar. What's the one thing that's different between these two bonds? Zoom in a little bit, help you see. The what?
The compound.
Yeah, the number of compounding periods per year. So this first bond that we're looking at compounds twice per year, and the second bond compounds 4 times per year. So if we receive money earlier, if by receiving money earlier it reduces the risk of a bond, the interest rate risk, which one of these bonds is going to be less risky?
The last one.
Yeah. Right? Because this is compounding a little bit more frequently, that means we're receiving our money just a little bit earlier. So we're going to see that the duration is going to be slightly lower. So let's just go ahead and copy and paste this on down again, right? Similar structured, as long as the information is structured the same, we can just keep on copying and pasting on down. Right? And exactly as we predicted, the duration on the second bond is a little bit lower than the duration on the first bond, telling us that it's a little less sensitive to changes in interest rates. Now, an important thing to keep in mind, duration really only matters to anyone who might be selling a bond over the bond's life. If you're holding a bond to maturity, it doesn't matter what happens to the price because you're just waiting for the maturity to occur and you to receive the par value. All right, so duration is only a measure that's of interest to people who are potentially going to be selling a bond sometime before maturity. Any questions on bonds? Yes.
Could this be worked out without Excel?
Yes. Yeah.
So for the settlement and maturity, how would that actually be looked as far as?
So pull up the formula real quick. There we go. So basically, you could set it up like a cash flow table, but you're going to need an additional row to multiply the present values times the year that it's in. So basically what you're using instead of settlement and maturity are literally the number of years between when you purchase the bond and when the bond matures. So that's what N is the number of years between purchasing and settlement. Any other questions? All right. So be able to wrap up a little bit early today. Again, I definitely recommend checking out the stuff that I posted on here. A lot of great events going on this week, especially for economics and finance majors tonight. Right, this networking club is going to be an excellent opportunity to meet local executives. If you're available and intend on working in this field, this is going to be a great opportunity for you. All right, next class we'll be talking about introduction to stocks. So if there aren't any other questions, I'll see y'all on Thursday. You too.
I can't figure out what you did.
Wait, so which one is the next?
How you do it?
What was that? I feel bad, bro.
Yeah.
I'm 0-4. Like last week, I benched. So I benched this week. I benched Xavier Worthy, and all of a sudden he has like a touchdown, like a 4-yard touchdown, and all of a sudden he's giving me all the points. Stephon Diggs, I benched him too. He had a touchdown. And last week, none of them had a touchdown. Like you gotta be kidding me, bro.
You can't send someone. Yeah.
Then they go off.
You can't do it while I'm on my app one.
They don't do
Gotcha. Interesting. So how would you set up a brokerage account? Would you have to go through a bank?
They told me to
in
try
your home
my
country?
local bank.
Okay.
So, because I have I'll choose bank. Try that one.
How far away?
I don't think so. No. I don't know that I do.
National Association.
And you're not gonna. You're not gonna have like.
You're part of the economic development.
Oh, very cool.
Evo didn't come in like.
The conference yesterday that Jerome Powell was at. What you're talking about?
Was it in Nashville?
Yeah.
I think so, yeah.
So you got to see him?
I didn't get to go because I was
Oh.
working.
Oh, okay.
Yeah, they have them like twice a year.
Okay.
Kind of thing.
Very cool. Yeah, if there's information you want me to post about that organization, let me know and I can put it on the commercial page. But yeah, that's a great event to be, I think, yeah. Yeah, have a good day.
Oh, I had a question. I noticed when I took the exams,
Mhm.
the little quizzes, that I forgot to mention about, you know how we did the homework, the extra time? There wasn't extra time on the quizzes. And this time I didn't need it,
Okay.
but next time, I don't know. Does that make sense?
I thought I got that. Can you send me an email to just remind me to check all that? Yeah. I was literally just meeting with D2L representatives today about managing that sort of access. So, yeah.
Thank you. I definitely send you an email.
All right. Thank you.
Have a good day.
You too.